Welcome to Kalkine TV's special segment on exchange-traded funds. This is Sage, and as you know, we bring you industry leaders and business advocates to help you understand how you can create multiple passive income streams. And today, we're very lucky to have Gemma Weeks from ETF Securities Australia. And ETF Securities Australia is an independent champion of specialist ETF solutions, and their innovation-led ETFs are built to help investors and their advisors achieve better investment outcomes by providing access to yield, thematic equities and commodities. So to give you a bit of background, Gemma Weeks is responsible for servicing stockbroker and wealth manager relationships across Victoria, New South Wales and Queensland, and she joined ETF Securities in 2015 after initial experience with the London team from 2012. So it's an absolute pleasure to have you here. Welcome, Gemma.
Thank you very much, Sage. Lovely to be here.
Great. And I'm sure our investor audience is very keen to hear from you, as I am. So let's begin with our first question. We're talking at an important time. Australian ETF market has recently breached 100 billion mark in the Australian dollar. When it comes to funds under management, what has led to this inflow and growth of 80% in just 1 year?
Yeah, so it really is a really important time for the exchange traded fund market here in Australia. And really this growth, it's not just been in the last year, it's something that's been really trending over the last 5 years. So if you look at the market about 5 years ago, we were sitting at about 18 billion. And now, as you said, we're well over 100 billion. So that's a huge amount of growth in just that short time. And I think one of the reasons for this is, there's been a lot of education around ETFs now, and people are really starting to understand the benefits. So, they're low cost investments. You can get great and easy access to all these different markets around the world. And then if we look last year, obviously, as you said, there was huge growth last year. And that was really spurred on by the pandemic. So there was a couple of reasons there. Obviously, we had a lot of people at home, stuck in lockdown, who were wanting to invest. They had a lot more time to look at the markets and start investing. And it was actually a much younger demographic coming into the market to start investing as well. And those younger investors are much more open and interested in using ETFs. So that was one of the big reasons. And then if you look as well, obviously we had that huge dip in sort of March and April last year, and then a massive amount of returns following that, and growth in the market. So people really wanted a way of accessing that growth, particularly in companies like, the big FANG stocks and those big tech companies that did so well last year. They're not really something that people could just access directly in the Australian market. Whereas you look at an ETF like our FANG Plus ETF, that provides exposure to companies like Facebook, Apple, Amazon, and you can get that just through that simple ETF trade. So that's really why I think we saw all that growth, particularly in the last year, but trending over the last 5 years as well.
Wow, that's really interesting news, especially at the time when those major US techs are reporting their earnings for the last quarter.
Yes, exactly.
Yeah. So we're sitting on unprecedented levels of global liquidity at the moment. How do you think ETFs will do once the liquidity in markets starts coming down or back to normal after the pre-pandemic?
Yeah, so this is actually a question that comes up with ETFs quite a lot. So it's definitely one worth looking at. But what's good about ETFs is they actually have a double layer of liquidity. So the first layer is the liquidity that you see on screen. So ETFs are listed on the ASX, so you trade in the same way as a stock or a share. But with ETFs, they actually have a market maker. And that market maker is there to facilitate the trading on both the buy and the sell side. So you're not relying on just another investor to be in the market to want to buy or sell against you. There's actually a market maker in there to sort of guarantee the trading if you go in at the right price. So that's sort of the first layer. And then ETFs are also open-ended. So there's probably only going to be a small amount of volume that you necessarily see on screen at any time. But that doesn't mean that that's all the volume and liquidity that's available, because the market makers can simply create new units in the ETF. So that second layer of liquidity really comes down to the underlying exposures. So if you look at something like that FANG ETF that I mentioned, obviously Facebook, Apple, Amazon, they're some of the biggest and most liquid companies in the world. So So the market maker is not going to have any issue in buying more of that underlying stock. And actually, when we build an ETF, one of the key components that we look at is how liquid the underlying investments are. Because obviously we don't want to launch an ETF that people are going to get stuck in and not be able to trade in and out of. So, I think last year was actually quite a good test where we saw all that volatility and we really didn't see any issues or any trading halts in the ETF market. So I don't think that the liquidity coming down is going to cause any problems there.
Excellent. Thank you so much for your insights. That's very valuable there. And I believe ETFs are beneficial for their ability to be diversified and create diversified portfolios. So yes, very interesting knowledge there. If you had to deploy the funds, where would you deploy them? Developed economies or emerging markets, and why, in your opinion?
So this is a bit of a tough one at the moment, obviously, because a lot of countries around the world are still being impacted by COVID. And it's particularly the emerging economies that are struggling. So if you look at, India and Brazil in the news at the moment, they're obviously being really impacted by these second and third waves. So there's a lot of risk and volatility in emerging markets. But at the same time, some people might consider them to be cheap. So as a way of getting in for a long-term investment, whereas developed markets, on the other hand, have obviously, majority of them have recovered quite nicely. They're doing great, vaccine rollouts and the economies are opening up again. But at the same time, do people think they may be expensive? So I think the key thing here that I would say is diversification. And you can diversify so easily across different markets with an ETF. So you could get just, an all-world global ETF, or you could take a specific ETF, like our robotics and automation ETF. Whilst that's accessing that particular theme, it's actually broad across developed and emerging markets as well. So you get a bit of everything in there. So I think the answer would be diversifying across both.
Absolutely, to help keep you buoyant or keep the portfolios buoyant. And that's really interesting what you say about the emerging markets, because you get some amazing developments out of Africa coming in the robotics and mechanism type industry. And then cryptocurrencies, again in Nigeria and Malta, seem to be huge, but yet also very volatile. So yes, cryptocurrency is still quite underground and not mainstream yet in Australia, but who knows what will happen in the next few years. Interesting space to watch.
Definitely.
So there has been growing attention on the Asian markets. As a person from the ETF industry, how bullish are you on Asian markets?
So again, I think this all comes back to COVID and how each individual country is really coping with COVID-19. So if you look at obviously somewhere like China, they've been pretty robust over the whole situation. Their economy is still growing. Yes, that growth is slowing a little bit. And obviously there's a lot of political elements coming out of China as well, which could cause some volatility. But China's been pretty robust. And then you look at somewhere like India, as I mentioned, which is sort of in the wraps of this second wave of COVID at the moment. And they last year got hurt really hard by one of the world's strictest lockdowns, which really sort of dampened the economy. At the start of this year, India was actually recovering really nicely. And then it's just, as I said, in the grips of this second wave, unfortunately. But there are still positives there, because this time the Modi government has said that they won't implement a national lockdown again. So they're going to try and keep those just to individual regions. Right. And we have also seen, so we have an India ETF, so you can get exposure to India through our Nifty 50 ETF. And what we've seen is, because it gets exposure to the top 50 by market cap, a lot of those companies have been reporting really positive earnings from Q4 last year. Mm-hmm. And that's actually helped boost the fund's performance. So we haven't actually seen a big fall in performance despite what's happening with COVID over there at the moment. So I think a lot of people take places like India as that long-term investment still. So Asian markets as a whole, I think, again, a lot of volatility, but a lot of potential for that long-term growth.
Yes, India's economy is very interesting to watch, because it's got a whole space program there, and They're coming through with the electric vehicles, but it'll also be interesting to see what will happen with China's and India's ban on cryptocurrencies, which is due to start in a few months, I believe. So another interesting space to watch. And thank you for your insights. You have talked about virtualization and digitization as a megatrend while they are hot selling amid a pandemic. But it is sustainable, or do you believe, in your opinion, would it be sustainable post-pandemic, and why? And another part to the question, if yes, has the world moved to a new normal perpetually?
Yeah, so I absolutely think that this space is definitely sustainable going forward, and the growth that we've seen in it. In my view, it's actually an area that has been moving that way for a long time. And the pandemic's really just sort of accelerated our growth in these different areas of technology. And there's a number of reasons that I think it's really sort of here to stay. So you think of the convenience of new technologies now, and people being able to have that flexibility of working from home, getting shopping to your door, and not having to leave the house every time. And then if you look on a business level at company scale as well, those that have implemented, technologies like automation, and if you look at Amazon as a testament to how successful this can be, but by implementing those technologies, they're really improving their efficiencies, bringing a lot of costs down as well. So I absolutely, think over the long term that these trends are here to stay. And now actually as well, there's a lot of government policy backing a lot of these technologies. And that's what I think is going to turn them just from, thematics and trends to those long-term mega trends. So one of the ones that we've seen a lot of growth in last year was battery technology. And our 𝐴CDC ETF actually captures this theme. But obviously with the likes of President Biden coming in November last year, he's pledged a huge amount of money towards clean energy and renewables. So that's all helping driving growth in that sort of battery technology space. And that's why I think we're going to see continued development in technology as a whole.
Absolutely. And I love how Australia's Prime Minister Scott Morrison is planning on investing a lot more in developing technological partnerships that can help keep the costs of more green conscious technologies down for Australians, because at the moment I think it's quite a costly area for us, and that's why we're sometimes criticised for lagging in that area. When it comes to real assets, as risk appetite of people is increasing back, gold as an investment is losing sheen. We're seeing inflows into the gold ETFs coming down. How do you see this trend shaping up on the front?
Yeah, so this is a really interesting one again, because at ETF Securities, we actually have the world's first physical gold ETF. So the code on that one is GOLD, so gold. And we've launched that in 2003. So it's been running for a really long time. But last year was by far our best year on record. So we had a huge amount of inflows last year. Really, a lot of people moving to gold as that safe haven asset in the volatility that we saw. But then, as you mentioned, this year, the start of this year, certainly that growth did slow. But then again, in the last couple of months, we've actually seen about $50 million of inflows. And I think the reason that we're starting to see this pick up again is sort of twofold. So the first is because gold is a true diversifier. So gold has low to negative correlation to other major asset classes. So by having just a small amount of gold in your portfolio, it can really help to improve the risk-adjusted returns. So more and more people now are learning about those benefits of gold, and rather than just using it as a tactical allocation, it's becoming more of a strategic and a long-term part of portfolios. And then the other reason that I think we've seen this shift just more recently and more people buying back into gold is because of the inflation risk. And people do use gold as an inflation hedge. And it's also there as that event risk hedge, because last year's COVID pandemic sort of came out of the blue. We never know when something like that's going to happen again. So gold almost acts as that insurance policy on your portfolio.
Thank you for that. Yes, very insightful indeed. almost at the end of the questionnaire. We have a couple more questions to go. So the world's first inverse crypto ETF made a debut in Toronto on Thursday. And this coincides with the world's first crypto exchange being listed on NASDAQ. Do you see a new trend there, Bitcoin versus anti-Bitcoin, in your opinion?
Yeah, so this is an area we get so many questions from investors on. So there's obviously a huge demand for Bitcoin and cryptocurrencies at the moment. So I definitely think the world is trending that way. Obviously here in Australia, there's no way of accessing Bitcoin directly. So people are having to look offshore. And I think what that means is that we're still a very long way of getting any sort of inverse Bitcoin ETF here in Australia or option to invest inversely. And actually where we've seen most of the demand is on the long side. So I think the trend is not necessarily Bitcoin versus anti-Bitcoin, because it's something that everyone's talking about. I think the trend at the moment is just everyone desperate to get some sort of investment in Bitcoin and cryptocurrencies. But certainly I think down the line, absolutely it will be Bitcoin versus anti-Bitcoin and seeing what way people can go.
That's really interesting to hear, actually, that you're getting so many inquiries into that area, because I guess it's people's fear of missing out. They don't want to be left behind if Bitcoin really does take off, which a lot of people are predicting that it will. And more people are moving from actively managed funds to ETFs. Why is this shift happening?
So I think there's actually a number of reasons that we're seeing this big shift now. And one of the first and most important reasons is really cost and performance. And I put those two together because traditionally ETFs are a lot lower cost investment vehicles. And that's because they're passive. Whereas active managers will typically charge a higher fee. But if you're paying a higher fee, then you would expect to be getting better returns. Obviously you want more bang for your buck. But actually, in most cases, we found that the active managers aren't necessarily outperforming. And Standard & Poor's, one of the big index providers globally, they actually run what they call the SPIVA report. And that's where they compare the performance of active managers around the world with various index and benchmarks. And what they found is actually in the majority of cases, the active managers underperform those indices. So that's one of the big reasons I think people aren't getting the performance they expect from active managers now. So they're moving more to lower cost ETFs, but not sacrificing the total returns there. And then another reason is obviously, there's so many ETFs available now. So there's well over 200 listed on the ASX. So you don't have to go to active managers now to get exposure to things like yield. You can get exposure to, as I mentioned, those themes like robotics and AI and battery technology, which all sort of international and global investments without having to go through those active providers. And then I guess the last point as well is the transparency and the ease of trading. So because ETFs are listed, you can trade them throughout the trading day as long as the ASX is open. So they're very easy to get in and out of. Whereas for an active manager, you can often be locked in for certain periods. It can be harder to get in and out of if you want to get out of something quickly. So it may mean that you sort of miss out on performance or even get stuck in negative performance. And then I mentioned the transparency side as well. And that's because with an ETF, you can actually see exactly what's being held in there. And we show you the weightings as well. So on our website, we have all the portfolios for each of our ETFs available. Whereas with an active manager, it's not as transparent as what you're actually investing in.
Right.
So yes, I think there's a lot of reasons people are moving more towards ETFs now.
Excellent. Well, thank you so much for your insights. I'll just let our investor audience know your company's website, which is ETF Securities.com.au. If you were interested in gaining more information about what Gemma Weeks and the team at ETF Securities does. So some very valuable insights raised there today about how diversifying your portfolio with a basket of securities and can be more cost effective as well as more liquid for investors. So thanks again, Gemma, for your time. Was there any last words you'd like to give our investor audience here at Kalkine?
Oh, just thank you very much for having me. And as you said, Sage, please visit the website for any further information on our funds as well.
Excellent. Thank you so much for fitting us in. I'm sure you've got a busy day ahead of you. And with that, this is Sage signing off. Another wonderful expert talk. Today, we were very lucky to have Gemma Weeks from ETF Securities. And as we always say, stay apprised and invest wise with Kalkine.